Welcome to the Michael Yardney podcast. In today's episode, Dr. Andrew Wilson and I will be addressing all the talk about Australia falling into recession. We're going to share the latest immigration statistics, which show Australia's increased its population by almost 500,000 people in 2022. That's much more than the Canberra. And we're going to explain what the latest unemployment figures suggest is ahead for our economy and interest rates. Now, those of you who've been following my weekly Property Insider chats with Dr. Andrew Wilson would know he's very opinionated, but his track record's been excellent, and today he's going to be offering a comprehensive analysis of the current economic landscape, and he's going to shed some light on the potential outcomes for our economy and our housing markets. So, without further ado, let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Regular listeners to this podcast would know I record a weekly Property Insiders video with Dr. Andrew Wilson, Australia's leading housing economist. In a moment, I'm going to be playing the audio of last week's chat. But before I do, I'd like to give you my thoughts about the recession that some people suggest we're going to have. Of course, you know Dr. Andrew Wilson's very vocal, and you'll hear his thoughts in just a moment. But first, as I said, I'd like to give you a couple of my own thoughts. And let's start with the idea that the media loves scaring us. Remember, they warned us about all those many cliffs, interest rate cliffs, and unemployment cliffs, and all those other cliffs that didn't occur. And the media love telling us about property crashes that haven't eventuated, and now they like scaring us with the thought of a recession ahead. Now, the technical definition of a recession is 2 quarters of negative GDP, economic growth. In other words, a 6-month period of negative economic growth for our country. Now, as you're going to hear in my chat with Andrew Wilson in a moment, both Andrew and I lived through the recession of the early 90s, and at that stage unemployment rose to 10%. That was a terrible time, and people just couldn't keep up their mortgage repayments. However, with the current levels of low unemployment, a technical recession isn't going to affect the average Aussie like previous recessions. Now, you may have also heard about the concept of a per capita recession. A per capita recession refers to a situation where the average economic output, the gross domestic product per person in a country decreases. This can occur if the overall GDP of the country is still growing, but the population of the country is growing faster than GDP. In other words, a per capita recession happens when the growth of the population outpaces the growth of the economy, leading to a decrease in the amount of economic output available per person. Now, that's a lot of fancy terms, but it's important to actually understand, and we're probably going to have a per capita recession, but it's important to understand that while it's not a recession in the traditional sense, which, as I said, requires 2 consecutive quarters of negative GDP, it does actually represent a significant economic slowdown, and it also represents, I guess, a decrease in living standards and economic hardship for individuals. And let's be blunt, that's happening for some people at the moment. And while I think having 500,000 new Australians spending up as they form new households is going to stop our economy falling into a technical recession, I believe it's quite possible we will slip into a per capita recession. The problem is the Reserve Bank Governor Philip Lowe's engaged in a conventional central bank solution to bring inflation under control. He's just raising interest rates. But let's be blunt, that's really the only tool he's got. And while our economy is slowing, it's holding up well, and as you'll hear in my discussion with Dr. Wilson, we're creating more jobs and unemployment is falling. That's actually not what the Reserve Bank wanted. And inflation's remaining high, and that's not really what the Reserve Bank wanted either. So Governor Lowe's also contending with a number of other inflationary forces, including the rising cost of rental housing and the federal government's second tranche of workplace reforms where people are getting more wages. And if you think about it, all these people coming to Australia are going to be spending up because we're not letting refugees into the country. We're bringing people in with big checkbooks, fat wallets, and they're forming new households. So that's going to be inflationary as well. So I guess the Reserve Bank Governor, Philip Lowe, has got a tough job. Maybe that's why he's got $1 million pay packet. So what's the Reserve Bank going to do on the first Tuesday of next month? I hope they're going to pause. I hope they're going to wait to see how things pan out over the next few months. But in my mind, that's going to take guts. I don't know whether they've got it. Look, let's look at a couple of facts. We've had 12 interest rate rises in 12 months. That's the fastest monetary tightening ever in Australia. But interest rate policies work, but with a long lag. There's also a whole lot of other economic indicators suggesting our economy is slowing. Yes, we are creating jobs, but we're starting to spend less, and a recession is being tipped by many more economists now than was tipped a few months ago. But if you look at the history of things, central banks aren't really good at picking the right interest rate needed to beat inflation and to avoid a recession. I mean, the 1990s recession that I lived through showed that when unemployment went to over 10%, they just pushed it too far. Right now, we've got economic readings saying our economy's under pressure. Consumer sentiment is low, business confidence is low. The March economic growth was only 0.2%, which annualised, I guess, comes to 0.8%, which is historically very low. We grew at 5.2% in 2021 and 3.7% in 2022. So our economy is slowing. And even the monthly CPI data, which the Reserve Bank is only starting to pay attention to, that came in at a low 0.3%. But the annualised 6.8% figure had a lot of statistical problems with it. So as I said, it'll be interesting to see what happens to interest rates. But what about our housing markets? That's one of the reasons you listen to this podcast, isn't it? Look, last year, many of the major banks and several economists suggested our housing markets could fall between 15 and 25%. And that didn't happen, did it? And in my regular commentary, I suggested that was going to be unlikely, because just looking back in history, we've never had a fall of that magnitude, and conditions weren't anywhere near as severe as some of the challenges we've had before. If you think about it, house prices don't fall when there's a severe undersupply of housing stock. House prices don't fall when the vacancy rates are less than 1% and rents are skyrocketing at double-digit growth. House prices don't fall when unemployment is 3.5%, meaning anyone who wants a job can have a job and will be able to pay for their mortgages. And house prices don't plummet when auction clearance rates remain above 60% and definitely above 70%. And now, for the last month, they've been in the high 70%. So what's likely to be ahead for our housing markets? I think the extra 500,000 people who called Australia home in 2022 will underpin our economic growth and ease some of the tight job markets, and the sheer weight of their numbers could offset the negative impact of the rest of Australians spending less as interest rates bite. You see, as I said a minute ago, these migrants have to set up a new households, and that's going to be driving demand and fueling our economy. And many of these migrants are students, and their parents are paying their way. And we've also got a lot of new cashed-up permanent residents, and they tend to rent for some time before they buy, so they're not likely to feel the pain of high interest rates that the average Aussie mortgage holder is feeling. And the sheer weight of their numbers could offset the negative impact of Australians spending less as interest rates bite, and that alone could stave off the recession that some people are warning about. In other words, the traditional recession, 2 quarters of negative GDP, seem unlikely. In fact, the increased demand for goods and services is going to keep our economy growing and may even push up inflation further, and unfortunately that could lead to more interest rate rises. Of course, our property markets and rents just keep rising because the housing supply-demand equation just keeps tightening further. So, after all that news about recession, and we're going to get on to my chat with Andrew Wilson in just a moment, but after all that news about recession, here's some good news. Despite the 12 interest rate increases, all the property research houses and the banks have all agreed that we've passed the housing market bottom earlier this year. If you think about it, an opportunity like this to get into the beginning of a new property cycle doesn't happen very often. Now, even though I'm not suggesting you try and time the market, this is in fact what most investors would love, isn't it? To get in at the moment, and you'll hear with Andrew Wilson as I speak with him in a moment, prices are still lower than they were 12 months ago. The way to solve the housing supply problem is for the government to help investors get back into the market. So how long are you prepared to wait to get set? Why not contact our team at Metropole? Go to metropole.com.au and I'll have an obligation-free clarity consultation with one of my property strategists to discuss your goals, to discuss your options. The worst's over. I know there's still going to be problems and the media's still going to keep scaring us, but the best is yet to come. So I believe now is a really good time to get your ducks in a row and get set for the opportunities that are going to abound as our markets pick up. But be careful, property investment's a process. You've heard me say that before. It's not an event. You can't just go out and buy any property and hope to be successful. I believe you've got to formulate a plan and get the right advice. And that's actually more critical now than ever. So as I said, why not have a chat with my team at Metropole? We don't have any properties for sale, but we offer strategic property advice. We give you direction, clarity and results. And sure, our buyer's agents would love to help you buy your next home or an investment property. But first, you've got to do things in the right order and get yourself set up with a strategic plan. And as I said, an opportunity to get set at the beginning of a new property cycle doesn't happen very often. So, with that really long introduction, let's now listen to the audio of last week's Property Insider chat with Dr. Andrew Wilson. And while you think about it, why not subscribe on my YouTube channel? Go to propertyinsiders.info so you can get my regular sessions with Dr. Wilson. Australia's population grew at the fastest rate in almost 13 years in 2022. According to the latest statistics from the ABS, it grew by a whopping 1.9%. We recorded almost 500,000 people coming to Australia at a time when we're experiencing a severe undersupply of property. And while those migrants don't bring a home with them to Australia, many of them come with fat checkbooks, meaning the tight housing markets and skyrocketing rents are likely to continue for some time. There was also other interesting news over the last week, including the latest employment figures and house building costs. So I'm looking forward to my weekly Property Insider chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Good morning, Michael. There's plenty of news around over the past week. And you've mentioned a few of those items, obviously migration, the really challenging employment data. And can you believe that low number of unemployed back again? The challenge is now for the ABS to, I suppose, maybe think about its credibility in terms of its measurement process. And I'm not being critical, and I completely understand it, but we are in that up and down period now through the holiday distraction parts of the year, which does suggest that the seasonal adjustment model is not working. And I wait with bated breath the retail sales data for May. And if that's another large jump, then we know that there are continuing issues with seasonal adjustment, but certainly very strong numbers on the employment front.
So what you're really suggesting is that the May jobless figures fell back to 3.6%. In other words, rather than unemployment creeping up, like the Reserve Bank's trying to do by raising interest rates, by trying to slow down our economy. In fact, we created 76,000 jobs over the month, Andrew.
It's roller coaster from month to month. And it doesn't work that way, Michael, unless there are seasonal factors. And the seasonal adjustment data is supposed to account for those factors, so we get an even playing field. The ABS mentioned in their commentary, the bounce back or the lower result over the previous month was because of the holiday season in April. Hello, guys, you're supposed to account for that. That's what seasonal adjustment is. And we know that seasonal adjustment has been thrown out the window through the COVID period, because those months that were typically weaker during COVID were actually stronger, and those months that were typically stronger during COVID were actually weaker. So it will take some time for that modelling to readjust itself, because you have to take a longer-term view over the data to get an accurate seasonal adjustment process. This is all part of that. So we have to take this data with a grain of salt. And I think, perhaps the ABS need to be a little bit more upfront about the issues, which aren't their fault, to do with seasonal adjustment. And, maybe we start looking at the this year versus last year type models over the current 12-month period to look at how changes have been made. But certainly we have to be quite circumspect about the data as it's coming through now, particularly in this first half of the year.
Having said that, the rate increases clearly haven't had an impact on the real economy, have they?
No, absolutely not. We're in a booming economy. Nothing's changed. We have getting basically the same results that we had, better than the results we had a year ago when we started increasing interest rates. So what's changed? Well, nothing's changed. It's still a booming economy. Interest rates haven't impacted the demand side of the equation. And the only adjustments we're seeing to inflation, in my opinion, probably would have happened regardless of interest rate increases as the supply chain became unblocked as we moved out of lockdowns.
Well, one of the reasons that our economy is doing well is that there are a lot more of us at the moment, aren't there, Andrew?
Yes, no surprise. We got the latest official population data from the ABS, and it is still backward looking, Michael. It looks at the December quarter as their latest snapshot of what's occurring. Very big numbers again, following the trend. It's interesting now we're seeing New South Wales and Victoria again leading the charge in terms of net migration over the year, over 2022, or over the December quarter versus the previous December quarter. Big rises, particularly in international migration. So they've taken over from Queensland with borders opened up now and just a wave of migrants coming into, as the usual destinations, of course, for international migrants, Sydney and Melbourne. Part of the story, I think, for increased rents, and we've also got the student factor that is an important driver, or part of the drive for higher rents is the student factor. But yes, look, still very strong migration, and that's going to put a lot of pressure on the supply side of the equation. We've got plenty of demand, not just domestic demand, but demand coming in from overseas. So that's a positive for our economy, of course, but the negative is that we're going to have trouble managing all this demand, particularly in property.
Well, over the last couple of weeks, there's been a lot of talk about the R word, about Australia falling into a recession. One of the big banks came out with the suggestion that there's a 50-50 chance of that happening. In New Zealand, they fell into a technical recession. But with all these extra people coming, 500,000 people, is that going to underpin economic growth and ease some of the tight labour markets, Andrew?
Yeah, well, whether we get into a recession or not, and let's remember we were just up by 0.2% with the latest GDP data, Michael. A lot of what's happening in GDP measures is a result of COVID. Again, that's, going to take some time to work its way through the system. But, I guess the banks have failed with their scare campaigns in terms of, their predictions in terms of house price crashes. Again, they look completely stupid in terms of their capacity to predict the housing market. No surprise that financial journalists also look pretty silly as well, followed all that clickbait in terms of the housing market. And now we're running into the recession scare campaign. But let's be very clear, a recession is a bogey word, and basically a bogey word because when we go back to the previous recession we had, Michael, which was in 1991, as you and I well remember, we had 10% plus unemployment. Hello, we've got 3.5% unemployment now. The way economic downturns impact Joe and Joanne Public is when they lose their job. Now, obviously, higher interest rates as they continue to rise will act to, one would suggest, to reduce employment and to increase unemployment. And that's not a good thing. But we're starting from 3.5% if we do start to see unemployment increasing. So that's a remarkably strong economy. It is a factor that is pushing up, helping to push up prices because productivity is not matching wage increases. So employers are forced to cover their extra labour costs with higher prices, and that's the issue we have, particularly with services costs. So as I said, it's just a bogey word. And again, it'll just be the bogey words like house price crash we had last year. And that, if we do get one, and that currency will last a month or two and we'll be back up and running again because we'll still have very strong labour markets to support confidence and spending going forward. But, it's all about chasing headlines. It should be about accountability too for those that continue to get it wrong.
Well, Andrew, many of these new residents are coming with fat checkbooks. We're not getting refugees in. They tend to rent for some time before they buy a home. So they're not likely to feel the pain of interest rate rises, of mortgage costs. On the other hand, they are going to increase the demand for goods and services. And that's likely to just push up inflation further and only lead to further interest rate rises.
Yeah, it's a little bit. Well, I suppose there's an economic driver for high levels of migration. It's part of what Australia has done now for generations. So it's not going to stop. And there's also a political driver for migration as well.
It's only going to push up property prices and rents because the supply-demand equation just keeps tightening further, Andrew.
Well, that's right. And this is now a systemic long-term problem, Michael. It won't be solved, this problem, given in current circumstances. Again, we'll need some outside force to reduce demand. This is the problem. We have too much demand, not enough supply. We either have to match that with more supply, which we can't do because the roadblocks are now fully set in place and can't be changed, or we have to reduce demand. And reduced demand means basically another lockdown, shutting our borders again. Politically, that won't occur. So who knows what the future holds? We're in our 7th wave of COVID now. I don't think we'll ever go back to lockdowns. But the solutions are really not within the sphere of policymakers at the moment. We can only look forward to higher rents and higher prices, Michael. And I think those that are looking to blame the resurgence in Australian housing markets on migration, once again, it's a two-dimensional thought bubble, because most of the growth that's coming in our housing markets, and particularly Sydney, and we'll look at another amazing result in that Sydney auction market the weekend, coming from mid to higher price ranges. And they certainly aren't migrants buying in the eastern suburbs and northern suburbs of Sydney. Certainly migration will continue to surge, and it will place even more pressure on an undersupplied economy and an undersupplied housing market.
Just talking about those higher end markets in our big capital cities, I read a recent report that a lot of those transactions are being conducted with cash. In other words, not a mortgage, because these are people who bought their house 20, 30, 40 years ago, paid off their mortgage. So the interest rates are not affecting them. They're upgrading, they're downgrading, they're moving to the right spot because they can.
Yeah, and it's gathering momentum through all the capital city markets now, the revival. Obviously, Sydney has led the charge and it's strengthening. But we're now seeing the Brisbane market also picking up again after a very short, rest period for that Brisbane housing market. It's now starting to rise, along with all the other Southeast Queensland associated markets. Yeah, it's onwards and upwards again in terms of our housing market. But we must say this. We've been saying this, Michael, that the portents for a rising housing market have been here for quite some time. And what's going to drive the market over the remainder of the autumn selling season, which is only 2 weeks, but certainly through the year, will be the fact that prices are still lower than where they were a year ago, Michael. And this, of course, does incentivise those, particularly those cashed up buyers you're talking about, because they're buying at a discount. And even if you're trading in at a discount, the upside is better for you because you get a better discount as you go up the food chain. So there's plenty of incentive. Fear of missing out will start to drive markets. Now, the question is what happens when those value opportunities dissipate when we get back to peak prices again. We're still around 4% lower in Sydney than where we were a year ago, similar in Melbourne and similar in Brisbane from their previous peaks. So when we get back to the peak house prices, we lose that discount value. And that's a question of what happens with our housing markets going forward. But according to a lot of the banks, who are characterised now as being wrong just about all the time, we're going to see interest rate cuts coming along soon, and that'll only help that housing market. So interesting times, but you scratch your head and pull your hair out if you've got any. And
the banks have changed their forecast, and they've all suggested now, the 4 big banks, there's going to be 2 more interest rate increases, and then they're all suggesting interest rates are going to drop in 2024 at various rates, depending upon which bank economist you're talking about. But getting back to those markets, there's quite some depth to them as well. We'll talk about the auction results in a moment. But we're finding at auction there are multiple bidders. And when somebody misses out, there's 3 or 4 people actually who've missed out who are now starting to feel a little bit of FOMO. So they go to auctions next weekend. And the market definitely has changed over the year.
Yes, it has, Michael. And I think markets are now, as confidence is returning and people are just ignoring the rubbish they read and hear and looking at the results, the real results, and realising that if they did listen to it, they've missed out again. I think that the other point to all that is we're seeing the value markets emerge. And I think Melbourne's still a good value market. I think Melbourne has still got a little bit of a hangover from the severe lockdown policies that it had to put up with. And, we're seeing that now with very strong rental growth coming through in Melbourne. Last week, we looked at the latest rent report. And Melbourne unit rents were up nearly 7% over the month, but they're still amongst the most affordable of all the capitals, Michael. And I think with the surge in migration, and we would expect Melbourne to be one of the leaders in terms of migration, international migration, that's only going to put more pressure on rentals, particularly in suburban unit rentals. There was, so much to choose from 18 months ago during lockdown. Now it's completely reversed, and rents are picking up in regard to that. So, Melbourne still is at the margin the most affordable place to rent a house and a unit. But of course, a lot of Melburnians left to move into southeast Queensland during lockdowns, and that affected the rental market and pushed rents down. But now we're seeing the reverse of that, driven by, to a large degree, not just the inherent increase in local demand, but also obviously migrant demand, particularly from students. But I think there's the same energy in the price market, in the buying market. I think there's still some upside to Melbourne in terms of prices growth, for a little bit of the same reasons that the COVID impacted the rental market, but more that the buyers are now moving back into the market with a lot more confidence. And I think we'll see some upside in that Melbourne market as well. I think there's probably more potential in Melbourne than the other markets going forward, but it's all a revival environment and only exacerbated by the two factors we've looked at today. And that is a very, very strong economy, which is going nowhere fast in terms of easing, if that's not a double
yes,
a double paradox statement. And I think also the migration factor.
Now, I know my housing market also keeps a careful watch of house building costs because they feed into the inflation figures.
Yes.
What's the latest figures showing, Andrew?
Well, we have seen some marginal easing in the rate of growth over a year until the annual costs of quarterly house building costs, and this was derived from the ABS, Michael. We saw some easing, and of course, this has to occur in the sense that we can't continue to see those extraordinary rises that we saw as a result of the shortage of labour and materials that were confronted with that massive boom through home builder that the previous government introduced in early 21. But we are starting to see an easing in the annual growth, and we look at that data firstly in terms of its impact on inflation. Of course, house costs are an important part of the inflation model. We're now down to 14.4% annual growth, which is still quite horrific, but it is falling, certainly well below where it was a year ago, 21.7%, and its peak was 23.3%, and that's annual growth, quarterly growth of quarterly house building costs. But it's still a very high number. It's still rising notionally. It's just not rising at the same rate it was rising. It has having an improved impact on inflation. But the big picture really here is, and I suppose inflation's part of it, this is the big picture if you want to talk about interest rates. But the other point, of course, is that it's still a significant disincentive for builders in terms of their financial modelling. They have to cover still strong building cost increases. Of course, we know house builders typically work on a fixed price contract. So, they don't have rise and fall contracts. And I think what we'll see is those low building approvals as they're coming through. And we've discussed this, of course, Michael, will be even lower because the proportion of approvals will be impacted by high building costs. And even though some better signs, still no real relief, considering that growth levels are around 2 or 3% typically for building costs for house building costs annually. And we're still up over double figures, Michael.
Well, that's house building costs. Apartments cost even more to build. They're more complicated. So that's going to make it even less financially viable to build the new towers that we need in some locations to house all these people.
Yeah, that's right, Michael. And, typically Australians did look to those sort of out of suburban broadacre developments to match demand for housing. And that's where I guess most of us started our home ownership journey as first home buyers, was on the fringe with a new home. But that's certainly changing now, and there is a swing towards choice of apartments over houses, but that's a very difficult proposition for developers to get sort of higher density developments up and running, particularly in the areas where people want to live, which is a little bit closer into the city, closer to the CBD, where there's established infrastructure. The solution, obviously, in terms of volume is with apartments and perhaps shifting preferences, but the capacity to place them there is becoming more difficult.
I just wanted to interrupt this week's Property Insider chat to remind you this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat with you to help you take advantage of the new property cycle. If you think about it, an opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and your options? Remember, we've got no properties for sale, but we offer strategic advice to give you direction, results and certainty. This is the right time to get all your ducks in a row and get set for the opportunities that are going to abound. But be careful. Property investment is a process. It's not an event. So you can't just go off and buy any property and hope to be successful. Formulating a plan and getting the right advice is more critical than ever now. So why not have a chat with the team at Metropole? Go to metropole.com.au. Now, each weekend, My Housing Market releases the auction reports, much more detailed than many of the other research houses, breaking it down by state, by region and by houses and units. And you report that every Sunday morning in LinkedIn, and we publish it in Property Update. And the auction markets didn't disappoint again this weekend, Andrew.
Well, yes, Michael, we were back in town in terms of the weekend auction market results. Of course, the previous weekend, we had King's birthday, the monarch's birthday, long weekend in all our auction markets, with the exception of Brisbane, who has the holiday a little later in the year, I believe. But more strong results as the market bounced back. Of course, we only had a handful of auctions, particularly in Melbourne, over that holiday weekend. But certainly we had some strong results to resume. Of course, we've got to understand, Michael, we are moving into that winter market, which is typically a distracted longer-term holiday market. So we've only got really a couple of weeks to go before that starts to impact our auction markets. But when we look again at the results, Sydney had another spectacular result, 81.9% clearance rate. That's the second plus 80% clearance rate we've had in the past 3 weekends. Of course, the previous weekend was, even though it was a holiday break, it was still 77%. Over 500 auctions or properties offered for auction in Sydney. So a very, very strong result. We typically measure that boom word with 80% plus clearance rates, Michael. So it's really consolidating just how strong that Sydney market is at the moment. Of course, Melbourne rushed back in, 622 auctions reported or listed. And it had another strong clearance rate, a little bit below where it was a fortnight ago, but 75.4% is still quite a handy result for most sellers. Brisbane maintained its rage, I guess, above the levels that we typically relate to Brisbane, which shows that market is reviving, and it had a big jump in auctions also over the last weekend compared to the previous weekend, 68% clearance rate. Adelaide just looking like it's getting into winter mode, 75% clearance rate, which of course is a good result, but we're used to seeing Adelaide around that 80% mark. Again, it had a big jump in auction numbers following the holiday break the weekend before. And Canberra auctions up a little bit from the last weekend, but it was back to what has been subdued results that we were used to earlier in the year. And the Canberra market, it looked like it picked up, but it had a 58.4% clearance rate. But again, low numbers in Canberra. We look at the long-term trends. Sydney's now tracking 20% higher than where it was a year ago, Michael, in terms of clearance rates. Of course, markets were all affected by the doom and gloom mantra a year ago of rising interest rates. Melbourne, around about 10% higher than where it was a year ago. Brisbane at the same sort of levels of where it was a year ago. Adelaide, again, similar to where it was a year ago, still strong results. And over June so far, Canberra is still, and this reflects the small numbers of the last couple of weekends, but when we take the full 3 weekends of June so far, results in Canberra are still higher than where they were a year ago. So no surprise to some degree, Michael. More strong results as the market resumed. As we're alerting people, we will likely see some easing in clearance rates and certainly in auction volumes over coming weekends as we move into July. But you never know, we might have a robust winter selling season, Michael, because we've got that much energy in the market, still catching up where prices were a year ago. So it'll be interesting to see just what does occur over the next few weekends.
Well, we know buyer confidence is there and seller confidence seems to be increasing. Yes. Very few properties are being withdrawn from an auction. When we looked at the results 12 months ago, there was a reasonable proportion, particularly in Sydney and Melbourne, of properties that vendors just felt nervous and pulled out in the last week or two of the auction campaign. That's not happening this time around, is it?
No, confidence is in the market. Of course, results reflect that, and better results generate more confidence, and we move on. I think people are just completely ignoring if there's any negativity regarding our housing markets, and we're starting to get probably the next phase of the commentariat is to start talking about the bubble inflating, and that bubble always seems to be inflating, but it never seems to deflate, Michael.
Well, it doesn't burst, does it?
Well, it's a very, very light deflation, let me tell you. We've only had 4 years over annual years of declining house price growth since 1987. 4 in 1987. So if it's a bubble, gee whiz, it's a very little bubble. And as you said, it just sort of fizzes for a very short period of time. And even when we've seen those declines, the worst decline we had was 5%. And, we've seen massive growth in house prices over the journey. And we're now back in town again. But as I said, this is a market being driven by discount factors. It'll be interesting to see what happens once we get back to peak prices again.
Well, thanks for those great insights. Look forward to catching up with you again next week, Andrew.
Thank you, Michael.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset session today, I'd like to pass on the message that you get out of life what you tolerate. One of my early mentors, Tony Robbins, tells the story of being confronted by a homeless person on the street. And the man asked Tony if he had a quarter. Of course, this was in America, so he asked for a quarter. And Tony thought for a moment and responded, "Is that really all you want, a quarter?" And the man responded, "Yes, sir, absolutely. That's all I need." So Tony Robbins shrugged off as he dug his hand in his pocket, and he pulled out a quarter and held it in front of the man's face and said, "You get what you ask for from life. No more and no less." He took the quarter and gave it to the man and walked away. Now, I'm telling you this story to remind you that we all get out of life what we tolerate. Your life is a reflection of what you're willing to tolerate. If you have dysfunctional relationships, that's because you're tolerating dysfunctional relationships. If you struggle with money, that's because you tolerate not being financially free. If you tolerate being with a difficult boss, it's because you're scared and unsure of your future job security. Your life reflects your personal standards. But the beautiful thing is, you don't have to settle for this any longer. You can hold yourself and those around you to a higher standard. But it must start with you. If you want more love in your life, you've got to give more love. If you want more money in your life, you must give more value. People and life in general are a mirror pointing back exactly at what you put out. So, my message to you is, what are you tolerating in your work and your personal life that you don't want to be there anymore? Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?